Hello, this is Andy Harris with Evergreen Wealth Solutions. Thank you for joining us today for our late in the month April Outlook and Positioning Review with Martin Wilde. Martin,
Hi, everybody.
I think most of you have had the chance to interact with Martin. Martin sits on the investment committee. He also chairs the investment committee, and we work a lot together. Today, we wanted to talk about a number of things that are happening, where we're sitting from an economic standpoint, some opportunities, some threats, and some lively banter. So with that said, Martin, anything you'd like to add as we open up our deck?
No, it's certainly been an interesting start to the year, so look forward to touching on some of those topics.
Yeah, excellent. Yeah.
And the only other thing I would add is if anyone hears anything or has other specific questions, just reach out. We're always happy to jump on a separate live discussion and go over any questions you might have specifically.
Excellent. Thank you.
There it is.
There we are. A couple different areas we're going to cover today, but mostly let's get rolling with the outlook. Martin, how do you walk through these first couple slides?
Yeah, and numbers are moving around, so depending on the day that you kind of update the numbers, it's changing. But I would say the key thing, if you look in the year-to-date column, which the relative ranking of these has not changed, is you'll see that this year and last year, the S&P 500 has really been the dominant driver of market returns. And you see a really big gap between that and many other parts of the market. So whether it's the equally weighted version of the S&P 500 index, the same 500 stocks, just without emphasizing those big mega cap stocks quite as much. You see a big performance gap there. Also, if you look at the high dividend index, has not performed nearly as well in the recent period. Small cap stocks represented by the Russell 2000, international stocks, emerging market stocks. You just see across the board within the equity markets, it's really been all about the S&P 500 and really driven by those large technology names and enthusiasm around artificial intelligence. Only other thing to note, after a nice recovery in bonds last year, you see the 2023 number under the bond row that says Barclays Aggregate Bond Index was up 5.5%, down again so far this year. And what's driving that? Rising interest rates. So as we go through and we talk about what we're seeing, so much of this will come back to the Fed and what's happening with interest rates.
One area to highlight, if we were to look at the column labeled 2022 U.S. dividend stocks, I wanted to point out that the 10-year Treasury and dividend stocks were one area or two areas that were in the black in 2022, and you'll see that the S&P was down double digits during that period of time, and that trend has reversed, as we'll talk a little bit more. So much is tied to interest rates. As we look at the primary things that we've been thinking about for this year, there's a couple risks. Inflation has continued to become an issue, which we'll talk a little bit more about, particularly in housing. And it seems as though interest rates are staying a little bit higher for longer. Something that's on a lot of our minds is what's going to happen with this election. And would not be surprised to see some volatility and mudslinging as we get closer to Election Day. And last but not least is the renewed geopolitical conflict, particularly in Europe, whether it's Israel and Palestine, Ukraine, rumblings of Iran, China, Taiwan. There's a lot of things going on. Conversely, we've seen that there's been a lot of economic resiliency, particularly when it pertains to employment, and the economic numbers have been very strong. As we talked briefly about on the previous slide, We've seen that there are some attractive valuations with the exception of portions of the S&P 500. But one of the things that we'll probably be talking a bit about is artificial intelligence, AI, and automation driving efficiencies that could drive additional profitability. And we think that we're at the beginning of a longer trend as it pertains to AI. Martin?
Yeah, and one thing on I think a lot of the initial gains have been in the stocks that are directly tied to AI, that are making the AI chips or software that's really using AI and creating models. And I think that's reasonable, but I think over time, you're going to see a lot of AI benefits that maybe are not being priced into other sectors in terms of AI being used to really enhance the productivity of companies. And that can be in manufacturing companies and how they optimize supply chain and inventory management. It can be things as mundane as customer service and being able to really improve outcomes using AI. And we've seen some evidence of that. And also in sales related areas where you're starting to see AI step in and make the whole sales process more efficient. So I think you're going to see right now, it's been really a technology story, but AI is going to be about productivity. And it's going to be across a lot of different industries, not just the tech sector.
Did somebody say interest rates?
Yeah, this is the thing everyone's talking about, and we're at our investment committees. This comes up frequently, is just the path of interest rates, and the blue line. Obviously, everyone's seen this before. Is what the Federal Reserve controls, which is the Fed funds rate, so short-term interest rates, kind of overnight lending rates between banks, and you can see how much that's come up. And of course, that affects a lot of other parts of our economy in terms of how interest rates are set. But as interest rates have come up, the Fed had expected, and many others, including ourselves, had expected the economy to respond more than it has. So the economy has been incredibly resilient. And that's as we entered this year, the expectations from the market was that the Fed was all but certain to start cutting interest rates. In fact, the market was pricing in 6 rate cuts in 2024. And what's happened as we've gone through the beginning part of the year is the economy's just been pretty strong. It's been stronger than expected. Spending's held up better. Andy mentioned employment's been really healthy. And as a result, inflation and the economic growth have been higher than expected. And now the big question mark going forward is the Fed going to cut rates this year? The expectations are still there'll be a rate cut or a couple of rate cuts towards the end of the year, but that's looking less certain as some of the inflation data has come in.
It kind of puts our Fed and our government in an interesting situation. Could you talk a little bit more about that?
Yeah, I mean, as far as the higher interest rates, it affects a lot of businesses that are borrowing, affects homeowners when they refinance their mortgages, business loans, people buying cars. I mean, interest rates have a wide effect, but something that's not often talked about is the effect that it has on just our own debt situation as a country and paying interest on the debt. And you can see when interest rates are incredibly low, the amount that you're paying, the Treasury has to pay on a regular basis just to pay the interest on the debt that's outstanding is a pretty low dollar number compared to when interest rates go up. That becomes a larger and larger piece of the budget. And we're seeing that happen. So what you're referring to, I believe, Andy, is the federal government finds itself in an interesting spot where higher interest rates really have driven up the cost of borrowing, and just servicing the debt, paying interest on the debt has become a huge line item in our budgets and in our annual budget. And that's something that will start to crowd out other spending categories. And that's why there's real incentive for the Federal Reserve to cut rates, also just to help reduce the burden on what we're paying as a country on interest in our debt. So that's an interesting position that the Fed finds themselves in, and I think a very complicated one, because on the other hand, you're still dealing with a strong economy and the prospect for increasing inflation. And speaking of
Almost like that I had that in queue.
yeah, speaking of inflation, you can see just visually, this is the path of inflation over the last couple of years, and you can see inflation peaked in mid 2022 at 9.1%. This is the amount of price increases that we're seeing for a basket of consumer uh, goods and services. So essentially, what's the average experience for a consumer paying today versus this time a year ago? And you can see with that peak of 9.1%, it meant broadly things were almost 10% more expensive than the year before. What does the Fed want and target? They're targeting a 2% year over year increase in inflation. And you can see visually how, as we rolled through these interest rate hikes, inflation started to respond. Looks like it's working, it's doing its job. And you see inflation went from that high level of 9.1% into the eights and the sevens and all the way down to the low threes. But look at what's happened on the far right of the graph. More recently, you start to see a little bit of an uptick again. So it does not look like, if you're observing this graph, that we're on this state, this nice slow glide down to 2%. It starts to introduce the question, is inflation starting to pick up again? And that's what had investors pretty concerned, and why we've seen some volatility and selling in markets over the last couple of weeks, because this inflation data was a little bit hotter than expected, a little bit higher than expected. And while it's still a lot better than where we were, 3.5% versus 9.1, the question is, are we getting down towards the Fed's target? And that matters because that plays into the idea of, is the Federal Reserve going to cut interest rates? Or if this graph turns around, starts going up again, perhaps the Fed will find themselves in the position that they have to raise rates again, which would not be good for financial assets.
Well, we've spoken a fair amount about how strong things are. And just to reiterate that, you can see strong jobs market has powered the economy forward all year despite calls for recession. And in fact, we've had a couple years in a row now in which we've had calls for recession, and just has not had that occur yet. Unemployment is still below average, and wages are not growing faster than inflation. Anything to add to that, Martin?
No, I think that the labor market is still really strong. And then as far as GDP, we talked about economic growth being healthy. This is a long-term graph of economic growth trend, and you can see in the table that the economic growth has been pretty healthy, a little bit over 3% in the fourth quarter, and expected looking pretty good for the first quarter also. So when you look at economic growth, it's continued to surprise to the upside. And we have this table on the right that shows that breakdown of what is really driving the economy. And you'll hear that it's all about the consumer. And you can see almost 68% of GDP is driven by consumption. So it really is on the backs of the consumer. And that has been an area where, despite rising interest rates, despite the inflationary pressures, people have continued to spend. And that's been one of the strengths. Now, some of that is supported by that strong labor market. When people have jobs, they feel better about spending. But we are questioning at the committee level, how can the consumer keep spending at the rates that they've been spending? Because that's really one of the key things that's been driving economic growth. And as rates come up, home affordability, if you just look at this chart, this goes all the way back to the 80s. The home affordability index is the lowest that it's been, kind of going back to the mid 80s. And that's a combination of high home prices plus high borrowing rates, high mortgage rates. So that's an area of strain, in addition to other drivers of inflation. So home ownership is less accessible now than it has been in a very long time.
As we've talked about in prior recordings, a big part of this is the supply demand. It used to be that people would be married to their houses, and now people are often married to their mortgages. We've had countless clients refinance at low rates as low as 1.99, low twos back in the early 2000s. And with new rates now hovering closer to 7, you really need to have a strong reason to move, which means that many people are sticking in houses, reducing the supply that's out there, which has a lot to do with it. Other, of course, is that we've seen construction materials become a lot more expensive. And so there's a lot going on there, but that's part of the inflation piece that's worth mentioning. As part of that, it used to be that people could easily go, heck, a couple of years ago, we had a fair amount of stimulus coming that the government was helping us throughout the COVID challenges. And one of the ways that people had access to money was low cost loans via their equity in their home. That's no longer the case, and we're starting to see that there are some cracks emerging. Saving rates have fallen below long-term averages, and we're seeing both auto and credit card delinquencies at highs not seen for more than a decade. I think if you lean that over to what's happening at consumer level, we go back to a little bit about what Martin was mentioning earlier about cost to service debt.
Yeah, and on the consumer side too, it's just credit card debt. We didn't have it on the previous graph, but it's at an all-time high too. So people have been continuing to spend. Some portion of that though has been on credit, and that's the part that we don't feel is as sustainable. And you start to see those delinquencies creep up. Just something that gives us a little bit of pause that consumers will continue the performance that they've delivered so far. And the other thing that we were highlighting before that you can see here visually, it's not an encouraging, comparison when you look at the amount of revenue that the federal government is receiving, which is on the right, versus how much we're spending collectively. And that gap is how much we need to keep borrowing on an annual basis. So not only do we have record levels of government debt, we keep adding to it in a significant way on an annual basis. And everyone understands this, who's run, just household finances. When you have a large growing debt component plus interest rates are going up, that dark blue component on the left, net interest, this is not paying principal on debt. This is just paying interest. You can see that the budget this year is for 870 billion. Some estimates put the number at closer to 1.1 trillion this year, which would exceed by a wide margin how much we spend on defense in aggregate. And that's just the interest on the debt. So this is one of the key things where as we keep borrowing more and interest rates are higher, it just becomes this growing component of government spending. And ultimately that will crowd out other forms of spending. So that's another thing that we look at that doesn't give us a really rosy feeling from an economic growth standpoint, because if you remember back to that GDP chart, nowhere near as big as the consumer, but the government and government spending is also a contributor to GDP. The argument or the area of concern would be if the government has to spend more and more money just servicing the debt by paying interest, there's not as much left for other sources of government spending.
One of the things that's interesting to talk about is that we're now seeing within areas of the market that have done well. Martin mentioned earlier artificial intelligence and many stocks that are related to that. I think there's two aspects that are now showing that 7 of the largest companies that we're seeing in the S&P 500 are some form of tech related, not very interest rate sensitive. But what we're seeing here is that these top 10 companies are now listed as the highest percentage of the S&P 500 that we've ever seen. Now, what's interesting about this in this chart that you'll see here is that those top companies rotate over the course of time. We look back to 1980, we see several companies that we haven't heard as much about recently, such as Standard Oil. You move to 1990, and Philip Morris, GE, ExxonMobil, Royal Dutch Shell, and IBM were the largest. This is just showing that it's unlikely that in 2030 and beyond that these same companies will be leading the pack. Anything you'd like to add to that, Martin?
It's just an amazing concentration when you look historically. This chart only goes back to 1996, but you could extend this all the way back the history of the S&P, and you'd never find a concentration that's as dramatic as these top 10 holdings are today. And the other thing that's interesting is, we had the technology bubble back in 2000, but if you look at the top holdings in 2000, you'll see that of the top five, only one of them was actually a technology stock. If you compare that to today, they're basically all tech stocks. Maybe Amazon, you could argue, kind of quasi tech. But it is interesting. There's just been a tremendous amount of concentration, and these are great companies. Nobody's arguing that they're not. But what you're starting to see is valuations that are really different than you're seeing in other parts of the market, and in some ways are starting to look quite expensive and stretched. And that's what gives us some pause here. And you can see that Andy just brought up the forward price to earnings ratio for the S&P 500. And again, this is being driven by large tech. But notice how, so the way to interpret this graph, it's not a price graph of the S&P 500. This is a valuation graph. So it's how expensive or cheap are stocks. A way to look at it is when the level is high, when the line graph is going up, it means stocks are more expensive than they've been historically. And when it's very low, you can see that they look very cheap. And you can sort of track that over time. You can see just how expensive stocks got during that technology bubble, and then how cheap they got during the depth of the financial crisis. And you can see today, we're not at the most expensive levels that we've been. In fact, we're not quite at the levels that we were in the post-COVID rally of 2020, 2021, but we're certainly much more expensive than we have been on average. And a lot of that is being driven by those large tech names.
I think that this is a great slide to illustrate that point. If you look at the top arrow, that will indicate the highest level that we've seen the price to sales ratio for certain asset classes over the last 10 years. So the first that we see there is US large cap core stocks measuring the S&P 500. And you can see that the highest level of ratio that we've seen is 3.3, the lowest of 1.6, average valuation of 2.2, and we're currently at 2.8. If you were to kind of segment the growth from the value here, what you'd see is that the large cap US growth stocks are measuring 4.7 out of 5.5. And look at that spread between that 5.5 and 2. There's a lot of dispersion there. Next, you'll see the equally weighted core stocks that Martin mentioned earlier in the conversation. And here you're going to see that things are kind of close to average. Next, dividend stocks are trading at a discount. Small caps are at a discount. Foreign stocks, and emerging markets all look really reasonable. So as we're talking with clients, we just really want to point out that while we're seeing really elevated returns and to some extent valuations within the S&P 500, we still think that there are great opportunities to invest at reasonable valuations in other aspects of the market.
Yeah, and the only thing I would add here, just because this is a little bit of a complicated chart to follow, just Andy did a good job describing this, but just really compare those blue dots in each of these categories to the yellow dots, and you can see exactly what he's saying. So just the current in blue versus the average in yellow. If the blue's above the yellow, things look expensive. If it's in line, if it's equal or below, they look reasonable or cheap. Is a very easy way to look at that graph, and you can sort of see what Andy was saying about that large growth column and how it looks very different than the rest of the market.
Speaking of large growth, I think one of the stocks that people have talked about a lot over the last couple of years is NVIDIA. Martin, could you briefly speak to this?
Yeah, it's a great company. They're really one of the most direct and biggest beneficiaries from the AI arms race. They sell chips that are very useful in training AI models. And you go back to and AI, I think everyone would agree is a very real, we talk about how transformative it is. And this is showing the price graph of NVIDIA, comparing it to the price graph of Cisco back during the run up in the late 90s. And at the time, the big technology trend that everyone was chasing was the internet. And Cisco really benefited in that arms race because they were the provider of internet bandwidth, routers and switches, and internet communication technology. And the internet turned out to be real. The internet was transformative, but Cisco got to be trading at incredibly expensive levels. And then when you saw a drop in demand, you saw a lot of saturation. People had, at least for the time being, got enough bandwidth, and some of the companies that were acquiring the bandwidth didn't end up monetizing it the way they needed to. You saw a big drop off in demand, and that caused a massive correction in the stock. We're not forecasting the same thing is going to happen with NVIDIA, but it is a risk. And the risk is not necessarily with NVIDIA itself. It's the downstream users of these AI tools that are reserving and paying for all this AI data center time and bandwidth to train. So essentially, NVIDIA is the tool provider, the chip provider for the AI revolution, similar to Cisco was the bandwidth provider to the internet revolution. And it's just a cautionary tale that even great technologies, sometimes when stocks get overdone, you can have a big sell-off in a stock, even if that technology continues to advance and be successful. And Microsoft's a great example. People forget, I don't think any of us would argue Microsoft isn't a great company, hasn't been a great company, was a great company in late 2000. But if you bought Microsoft stock in 2000, you were underwater for a long time, well over a decade. And it has nothing to do with Microsoft went through a decade of not being a great company. It's at some point valuation matters. At some point, what you pay for stocks matters. And that's part of the discipline that we're trying to instill in portfolios versus just being blind to valuation and chasing things just because they've gone up a lot. That's how you can end up in an investment in a good company, but not make money in it for almost 15 years.
In summary, I think Martin and I both spoke to the concern over highly concentrated participation in areas of growth within large cap U.S. stocks. But there's a lot of opportunities within small companies, dividend paying stocks, and foreign companies.
Yeah, no, I would just, I think we summarized it in terms of we do have exposure in portfolios to large growth companies. They're great companies. They've done well. We're not advocating people have no exposure there, but we are advocating that portfolios be more diversified into a number of the areas that Andy mentioned, because what we have seen in the past is if we have some kind of a slowdown in the demand for and the enthusiasm around AI, like we experienced with the internet and with the Cisco example, there are many other companies that have not participated that are trading at cheap valuations that have the ability potentially to do well in an environment that doesn't continually favor tech stocks. So we're just advocating investors be diversified, spread out their exposure, don't get too concentrated in one specific area. And the specific area right now that we would caution getting overly concentrated in is the technology complex, and especially names that have really benefited from the AI enthusiasm.
The other area to note that we're consistently talking about in client reviews is the higher yields available in fixed income and stocks, and which, as this says, allows investors to get paid to wait for future opportunities. It's been a long time since we've seen the fixed income portion of the portfolio do much more than add diversification. And now it's wonderful to be able to see nice yields. So if you are in a position of large cash reserves that are not earning much in the way of interest, I think it's wise to pick up the phone and see what your options are. And it is nice to be able to see the entirety of a balanced portfolio actually contributing to return. Kind of in summary, well, tell you what, this is all you, Martin.
Yeah, I mean, just right now the economy continues to do well, and we'll watch that. You know, it's surprised the upside. It's continuing to kind of run along at an over 3% growth rate for the economy. We mentioned some of the things that we're seeing in terms of elevated debt, credit card debt, increasing delinquencies, but you know what? It hasn't translated into a drop off in economic activity. We're watching it closely, but right now you'd have to say the economy is doing quite well. And then as far as markets go, I think outside of the certain stocks that look like they're fairly richly valued or have done really well. And there's a lot of opportunity for investors in the areas that we've talked about. So we're excited about a lot of the opportunities. Some of those stocks have not done well because interest rates have gone up, but we don't think that their businesses are solely reliant on interest rates. It's more investor perception. If things slow down, if the economy does not continue to do as well in the future, the Fed does start to talk about cutting rates more significantly, I think some of those areas like dividend paying stocks could do really well. And if we continue on the path we've been in and it's stronger growth and technology stocks continue leading the way, we have exposure there. But I think it's prudent to start to diversify into other areas that have not done as well. And that's what we've been doing in client portfolios.
So with that, we can bring this presentation to an end. We really appreciate the opportunity to serve you, our clients. That's our reason for being. If there's something you'd like to talk with one of us or your advisor about, please don't hesitate to pick up the phone, schedule some time to talk. We do think that this is a good time to make sure that your plan is updated. So if there are any things that are changing in your life that warrant a review, please don't hesitate to reach out, and we'll do the same. We'll be in touch next month, and we look forward to our next connection.
Thanks, everybody.
Bye-bye.